Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AMC stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AMC is the largest movie theater chain in the world. It operates over 900 theaters with over 10,000 screens. Their chains are located in 12 countries in the US, Europe, and Saudi Arabia. The company is headquartered in Leawood, Kansas, and was founded in 1920. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, and Bulgaria Stock Exchange. Let's get started with the model. This is a mid-cap company, 7.4 billion market cap. They're trading at $14.43 a share, and they have 513 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small positive in 2019, but once COVID hit in 2020, it's been negative since then. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's negative each year. They're worse in 2020, negative 4.6 billion. Revenue is the sales for the company, and that was 5.5 billion in 2019, then dropped a lot in 2020 for obvious reasons to 1.2 billion. It did double into 2021, and it's growing even more in the trailing 12 months up to 3.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is positive each year. It was 3.5 billion in 2019, dropped to 830 million, but has been coming up a lot since then. It's at 2.2 billion in the trailing 12 months. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. That's negative $500 million in the trailing 12 months. It was negative 1.5 billion in 2020. They spent 388 million of interest on their debt, which is a lot lower than 2021 of 459 million. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They did have a big negative in 2020 due to a large asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is negative every year. This is the income statement from the latest 10Q, the first quarter of 2021 versus the first quarter of 2022. And you can see their revenue has gone up a lot from 148 million to 786 million. More than half that revenue is from admission tickets, then 250 million from food and beverages, and 89 million from other. This other includes marketing on their screens. Some companies pay for advertising space before a movie starts. Here's a breakdown of their expenses. 190 million of film costs, 42 million of food and beverage costs, 345 million of operating expenses, rent of 220 million, 53 million of other, and 100 million of depreciation and amortization. Their operating loss is a lot better. It was negative 167 million. Last year was negative 428 million. Their net loss was 337 million. Last year in the first quarter was 574 million. So their loss per share is getting better at 65 cents. Last year was $1.42. They're adding stock as well. They had over 400 million shares in 2021. Now it's over 500 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. They lost 600 million of cash flow in the trailing 12 months. They generated 600 million in 2019, but they lost over 1.1 billion in 2020. They spent 124 million in capex in the trailing 12 months. Capex are investments in property, plant, and equipment. When they buy the real estate to put a new movie theater in, the cost of that real estate is part of capex. Operating cash flow minus capex gives you your free cash flow. And since they've been losing a lot of cash, they added a lot of debt in 2020, over 1 billion. They've also issued a lot of stock as well, 265 million, 1.8 billion, and 1.2 billion. Every time a company issues common stock, it increases the shares outstanding. It makes your shares less valuable. Let's look at the capital structure. They have negative 2.2 billion of equity. This means their liabilities are 2.2 billion more than their assets, and they have 11 billion of debt. So they're 100% debt, 0% equity. This is their capital structure since 2015. You can see their debt and equity were pretty close, and their debt has been going north while their equity has been going south, which is not what you want to see. But sometimes you need to do these things in order to stay in business. Because if you don't issue more stock and take on more debt, you may be forced into bankruptcy, since you need cash from somewhere to operate your business. I gave them the lowest whack on Finbox, 9.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.7 billion. We divide that by 513 million shares. And we get a calculated stock price of $13. They're trading at $14.43, so they're trading at 11% premium. It's a sell according to the model. Their revenue target for 2024 is $5.3 billion. For 2023, it's $5.2 billion, and for 2022, it's $4.5 billion. And I continued this growth into 2025, and I got $5.4 billion. That's how I got their future revenue estimates. The average company in their industry converts 12% of their revenue into free cash flow, so I multiplied their 2024 and 2025 revenue by 12%. That's how I got their future free cash flows. And I just assumed they would have negative free cash flow in 22 and 23. The website Simply Wall Street is really low on this one. They value the company at 32 cents. 5 analysts priced this stock, and the average price target is $7.67. The low is $1, the high is $16. This is where the stock has been trading the last 5 years. Lots of hedge funds were shorting this stock, and it looked like they were going to go to zero. But then there was a huge short squeeze, and the stock ballooned well over $50 a share. That means within a couple of weeks, the stock price went up about 2,000%. But obviously that stock price was not sustainable. So it's been coming down ever since. So it's hard to know if this is the bottom or if the company will eventually go bankrupt. It seems like they're doing okay and they'll get through this mess since their revenue has been going up. They have a beta of 1.75, so the stock is a bit volatile. It moves almost 2 times the market. It's gone down 55% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 10, the high is 73. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 50 million shares are traded each day. Pretty much all the shares outstanding are on float. 35% are held by institutions, and 21% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be at about $10,000 today. But at one point, you would have been down to about $3,000. And at another point, you would have been at close to $40,000. The CEO's annual salary is $1.5 million, and their total compensation is almost $19 million. In the past 12 months, there's been no insider buying, just selling. 178,000 shares were sold, 18,000 and 257,000. 65% of the company is held by the general public and 35% by institutions. Their employee count went down during COVID, but it looks like it's rebounding a little bit. They're currently at 17,100 workers. The biggest shareholder is Vanguard at 9%, then BlackRock, State Street, D.E. Shaw, and Geode. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales looks pretty good at 2.3. That's stock price over sales per share. That means investors are paying $2.30 for $1 revenue. We can't look at their price to book since they have negative equity, and we cannot look at their price to free cash flow since they have negative free cash flow. They can cover 80% of their current liabilities with their current assets. Same thing with the quick ratio, 0.8. In the trailing 12 months, they had negative $720 million of free cash flow. They have negative $260 million of working capital, so it looks like they're going to be short. So they may need to add some debt or equity to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 39 companies in the same industry as AMC, and if AMC has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in every single category except price to sales. They're at 2.3, the average is 3.2. They rank 12th in market cap at $7.4 billion, average is $18 billion. We can't look at their price to book, price to earnings, or price to free cash flow. Their 5-year annual revenue growth rate is -3%. The average in the industry is 5%. To summarize, I have them trading at 11% premium, and this company is the poster child for the meme short squeeze stock, because I believe AMC and GME started the whole short squeeze craze. So I guess it's good they get that publicity, and it is promising to see their revenue grow. I'm not sure about a long-term investment, but I don't think movie theater chains are going away, even though people have said that. I still think there's lots of people that like to get out and go to the movie theater. Even though I could watch almost any movie at home, sometimes I like the experience of getting out of my house and going to the movies. I rank their free cash flows 2 out of 10, their revenue 5 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.